At Staples Business Advantage, nothing can top the smarts and instincts of the thousands of experts on our team. While AI excels at
processing data, automating tasks, and providing insights for better decision-making.
And when they're used together,
They
they're
are far more powerful than either is alone. Whoa. I've never felt more alive.
Let Staples Business Advantage use today's latest innovations, plus our team's experience to make business easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
Then it's a question of how long away is that home deposit. In Sydney and Melbourne, the typical savings time is 9 years, in which case you're still talking about a long time horizon. It still makes sense to invest in at least a portion of equities, and you could just invest incrementally in them over a 9-year period. And let's say that you get the market return of 4%. Who knows what will be over the next 10 years, but 4% is pretty conservative. That will get close to cutting your savings time in half.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. Today we're talking about laziness, about sitting back and sipping Mai Tais while the share market does its thing on your behalf. All you need is time and discipline. Is that the case, Kurt?
You're very right. Well, that's exactly it.
Okay, Kurt Welcome is the co-founder of Pearler, a low-cost, slow-food, cruise control investing platform that encourages long-term thinking with free brokerage on some ETFs. Terms and conditions apply, don't they? We'll get around to that. The more topics I cover with this podcast, the more I'm convinced that ETFs are the best option for many investors starting in the share market. I was just relating that story before we started recording about the only time you hear people talking about shares around barbecues is when markets are exuberant and ebullient like they are at the moment, aren't they?
Yeah, absolutely. I mean, the bounce back has been, I think, on the top of everyone's list.
It's been astonishing, hasn't it? So in this case, we're trying to steer people more into ETFs because not everyone's going to be investing directly in the share market, are they, Kurt?
Yeah, well, like at Pearler, we're all about incremental investing in diversified portfolios for the long term. That's the mantra. I'll be saying it till I die, probably. The everyday person, it's just super simple, super robust way of getting to people's financial goals and not making investing a part-time job.
Yeah, that's right. Because a lot of people just don't have the time to do the research and the amount of time that goes into doing it well.
Yeah, exactly. It can take hours. What we're here talking about today, it's not for those sort of people. It's a different conversation to investing for the everyday person.
Yeah, that's right. So you're lucky enough to come from a family that encouraged you to think about finances from an early age. Tell us about that.
Yeah, I think it was just something I really wasn't aware of growing up until I had the ability to reflect on it. And it was just my parents smart with their money. They invested in property just like every boomer that's around. And then they went and reinvested some more, built it up, were conscious about making sure that cash flow was sorted and where their debts were. They never had any bad debts. So what I mean by that is debts on assets that don't increase in value. Good debts are things like a mortgage. Bad debts are things like credit cards, personal loans, things that you don't get actually anything back on. They really instilled these values in us subliminally, subconsciously, from a very young age, myself and my two younger brothers. And I guess we took that with us. It started even for me when I was like that first savings period around buying and selling chooks and rabbits at the local pet store and other things like that.
The spirit of an entrepreneur from a young age. Yeah. So did your parents invest in the share market as well?
They did. Never had much luck, to be honest. I don't know about always, but from what I know, it was only followed by stockbrokers. And so that's one type of advisor. And my parents were none the wiser when it came to shares, but they knew property inside out because they were real estate agents by trade. And so they kind of just focused there after getting burnt the first couple of times in the share market. That speaks to kind of do what you know. But for a lot of people, you're not in real estate and you're not in share market. So you do have to invest somewhere. And that's where, we'll get to ETFs and share market and passive investing soon, I think. But that's really where it comes in.
But you became interested in the share market at an early age as well, didn't you?
Yeah, I did. I'm not sure what it was that triggered me there, but I read The Barefoot Investor at 14. And for me, that was something that turned an interest into a passion. It was like second edition. I've still got the copy today with like My handwriting hasn't got any better.
Who cares?
And yeah, then the year after I started investing, I pushed in my 15K life savings into 3 stocks, again off full advice, stockbroker's recommendation, and the year was 2007.
The best time to start investing.
Yeah.
Well, the best time to learn about investing.
Yeah, but that was definitely the case. I learned a very good lesson. And one of those is around the diversification aspect. And it did definitely scar me. All 3 of those got smashed. 2 of them went to zero, never bounced back. And 1 did. It was just News Corp, so it floated around for a while and came back to where it was.
So what were the ones that you bought? What were the ones that went to zero? I mean, they completely went bankrupt, did they?
Yeah, they went bankrupt.
Yeah.
Very close to, anyway. One was Alco Finance Group, which was in the papers. It was meant to be the not so specky one, like mid-tier. News Corp was the blue chip. And I can't even remember for the life. I think it was what the first one was. I've erased it from my memory.
Yeah, you most probably would have. So how did it feel? How did that feel going through that?
So I had bitten the cherry, the apple, whatever it is.
Yeah.
Of investing is a long-term game. You've got to ride it out. The market has ups and downs and swings and roundabouts. And if you just hold on for long enough, you'll never go wrong.
What, you knew that from that sort of age as well?
That was the mantra. Yeah, that was what I'd read.
But you didn't feel that that sense of horror as you're watching the red on the screen.
But I
you
just
felt
kept
that, did you?
doing this over and over in my head, like
Yeah.
it'll be fine, and then and then it wasn't. And I kind of got a few learnings from that. First of all, I definitely wish that I had have had that exposure to, what diversification was. I still, at this stage, I had no idea what an exchange traded fund or a listed investment company really was.
Well, there weren't that many around. That was there?
Yeah, there are heaps more today. That's for sure.
So many more. Yeah.
The other thing was it really showed me the true colours of the finance industry at a young age, where there's got these people getting paid to give advice by you, and as a beginner, putting you into these specky stocks. It's just so immoral, reflecting on it. And personally, I never thought I'd actually be in the space as a co-founder of a new age online investing company. I always looked at my self-education as something that I'd have for me and my friends who asked and things like that. But nothing's changed in the industry. The opportunity came up to actually get involved and make a difference. And so that's where Pearler was born.
It's out of that philosophy, is it?
It's really that philosophy combined with a real clear need around our friends and family and experiencing this. How do I get started in investing? I feel locked out of the property market. I want to take control of my finances. And a change in society around we're now willing to talk about money for the first time in a long time. Money taboo is starting to fade. And that means that we've got, we were talking about FinTok earlier. We've got these different trends that are happening that are actually starting conversations. And, people will criticize that there are people out there talking about finance that don't really know what they're talking about. But I got to say, at least the conversation's happening.
At least it's starting. I know everyone's complaining about all of the pumpers and on Twitter and videos on YouTube. But it's true. It's like you say, people are actually having a conversation. And this podcast and many of the other podcasts are examples of this.
Exactly. Bringing it to people on their doorstep.
Mm-hmm.
Yeah.
So tell us about ETFs. When did you first realise what an ETF was?
So for those who don't know what they are, ETF is Exchange Traded Fund. It's a basket of shares. So essentially, you can spend $1,000 and spread it across the whole of the Australian stock market or the whole of the US stock market or even the whole of the world. So, we're talking thousands of shares that you can buy with just $1,000. That's the premise of it. The idea is you get super good diversification. Diversification means not all your eggs in one basket. You also can get really low cost access to it. Typically, before ETFs, you would have had to have bought all of these 2,000, 3,000, 4,000 shares individually, get charged a broking fee every time, deal with all the tracking requirements, and it's just prohibitive. And so ETFs, index funds first, were invented to solve that, and then they developed into exchange-traded funds, which is just a listed version of the index fund.
So you can buy and sell them on the share market.
Exactly. More accessible, easier to work with.
And it also came about because there's a lot of fund managers who don't even outperform the market either.
Well, that's it.
So the market is the market in a sense, isn't it? Yeah.
Yeah. there's some great studies out there, and the only one I'll reference is the SPIVA study, SPIVA. It's like an active versus passive professional managers comparison. And it will show you that over a rolling 5-year period, any comparison, passive outperforms active more than 50% of the time. And typically for your large cap indices, so they're the big companies that are out there, if you just look at...
So like the ASX 200 is the local example.
The 200, so the 100s to 200 aren't classed as large cap, but yeah, if you're talking about the whole ASX 200, yes. So a manager who focuses on the ASX 200 is a large cap manager. And so if you look at those, 70% in Australia, in the US, in Asia, will underperform passive over a 5-year rolling period. It's just like, well, why? Why pay the extra fees? Why pay the extra money? All this stuff. Just set and forget. Put it on autopilot.
And that it also gives you a perspective on if these are people who are highly trained in finance, who are living and breathing it all the time, have got access to managers and the best software and the best research. If they can't outperform the market, how can your average dude?
Yeah, on 10 hours a week after work, Yeah. Exactly. Although
that's the Peter Lynch story, isn't it? That you can outperform because you do have an advantage. However...
Yeah, I mean, that's it. Personally, and as a company too at Pearl, we've got nothing against going long-term on some high-conviction investments. But the responsible approach is comparing how your individual picks go against the passive strategy, actually investing in both to begin with, seeing how you stack up in performance, actually using a useful performance reporting tool like a ShareSite or something else so you know your annual returns, you can compare them, you can see how they perform against the indice, and then actually is that 10 hours a week you're spending picking stocks like worth it, 20, whatever, or is it even costing you, which is actually more often the case. And so tying it back to my story, Phil, like I was picking stocks with a long-term view since I was 16 then, after I got burnt that first time. And then when I was 19, I actually went and just did a big deep dive. It took me like 4 months on like Google spreadsheets to actually do the whole full-blown reporting. I didn't know that there were all these software tools out there that could help me do it, and found out that I'd done plus 0.1 on the market over those previous 3-4 years. It's like, you know what, I'm not enjoying this anymore. And I, at that time, found out about ETFs kind of maybe in the year before that, and said, that's going to be now my focus, and that's my personal transition as an investor. Mostly self-taught, although I do have a degree in finance from UNSW, so I could start to get deep into it. And I did work as an investment analyst for a while too, but I just don't want to spend my precious time.
Too many beaches, aren't there?
There's too many good things to do than be pouring through company reports, especially when I can get a really, really, really good result just by investing in an ETF, do it every time I get paid, put 20% of my paycheck in there, and away I go. That's kind of what we're trying to facilitate.
And think long term.
Oh, absolutely.
Because that's the thing with ETFs. They'll go down.
Yep.
If the market goes down, an ETF will go down. It's not a magic bullet in protecting your portfolio. So how should investors think about that sort of situation?
Yeah, for sure. Well, so the difference between an ETF and an individual stock is that they'll both go down. But if the ETF is sufficiently diversified, so the saying is broad-based, low cost, so like tracks all of Australia or all the US or whatever, then it will never go to zero, right? It will never end up as an Alco Finance Group, if it was for me. And
it'd be the end of the world if that happened, wouldn't
it?
Yeah.
If VAS A200, two biggest Australian ETFs, go to zero, that means Australia's economy is wrecked.
It's a zombie apocalypse.
Yeah, exactly. So that's why you can be confident that over a sufficiently long time period that it is relatively safe.
At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make stocking your team's breakroom easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
What's it been like starting a fintech startup? A fintech talk startup?
A fintech startup in the age of FinTalk.
Yeah.
It's been really challenging. It's been really liberating at the same time. Personally, passion of mine since I was 14. So that's been great. To be able to provide access. We've just passed 1,000 people who've signed up on Pearler's platform. It's phenomenal. Feels like we're actually making a difference.
$1 million. You've just hit the $1 million invested mark, haven't you?
We have. We went net invested $1 million. So most other trading platforms are focused on the trading experience. And so they have...
That's a nice way of saying brokerage fees.
That's it.
Yeah.
So increasing the number of buys and sells. And they're pretty ambivalent as to whether it's buys or sells. But for us, we're really focused on making the purchases much bigger than the sells, because that actually correlates with better financial outcomes for people. So we had 1,057,000 invested in Pearler, and we have had about 50,000 sold. So as a team, we're pretty proud of that. Big milestone for us, and we're stoked.
Yeah, well, we should just talk about it though. Pearler it's basically a trading platform. That's the basic. You can go and buy and sell ETFs, shares on this platform at low cost.
It's, if you want to sum it up, it's the anti-Robinhood.
Yep.
Robinhood makes trading much easier into direct equities. Pearler makes investing in direct equities much easier. That's the key difference. If you want to buy and sell, pick things, and you're doing it with a less than 1 year sort of time window, then you don't want to use Pearler. It's the Australian equivalents of Robinhood are like Superhero, Self-Wealth. There's some big ones that are out there.
eToro, there's plenty of
eToro
places.
as well. Yep.
Mm-hmm.
Yep. Whereas we're trying to build something that's fundamentally based around your financial journey, helping you achieve goals, get better financial outcomes. And so that's the difference. A few of the things that stand out is that we have Australia's first auto invest feature, for example. So you can
So this is the first time it's been available in Australia, is it? An auto invest feature?
Yes, into direct shares.
Yeah.
So you can choose an ETF or any stock actually and say, I want to invest in this 20% of my paycheck every time I get paid, and we'll do that for you. You don't actually need to touch it again. Or even a set of ETFs. We have a bunch of different rules, but that's how it works. Yeah.
Yeah. When we've spoken before about Pearler, you've mentioned that you've designed this site to make trading unattractive, or the kinds of bells and whistles that other trading sites have are not available on Pearler because you just want to encourage the long-term point of view.
Absolutely. So a lot of the defaults that are on your typical trading platform, for example, you have intraday trading, so intraday price changes as the default price graphs. And Pearler, we actually don't have any price graphs right now. And when we do have them, it will be 10-year defaults. So really changing the paradigm there. Another example would be we don't have any fancy order types right now. There's you can have 10 different order types, and it's so hard to figure out what it is you're meant to set, especially as a beginner. Should I do a market order, a limit order? What the hell's a stop loss order? All this stuff. You need to log in to the platform between the hours of 10 and 4, for some arbitrary reason. That's when the market's open to make an investment. Pearler, you don't need to do that. You can make an order at any time of day. We'll submit it when the market opens for you. It's that very long-term mentality. People might ask, well, what happens if the market changes overnight, whatever it may be? It's if you're investing for 12 months or more, then one day's change doesn't matter. On all of the ETFs that we're talking about, sure, if you want to get into detail on microcaps, it could, but if you're going to invest in microcaps, then you don't want to be using those features anyway.
That's right.
You know what I mean?
You're in a whole different paradigm, aren't
Exactly.
you? Yeah. So you've organised a method where you can get free brokerage on certain buys of ETFs, haven't you? Tell us about that.
Yeah, so we went to Australia's ETF managers and said, look, we're building this platform that promotes your products and promotes the right behavior in your products, being long-term, buy, hold, accumulate. We want to help the investors even get more deeply embedded into these great products that you offer, because genuinely ETFs are the thing that every investor should consider when they start as a starting point and also as the major portion of their portfolio. And everyone was interested, actually, when we talked to. And 3 ETF managers came to the table. They are eInvest, ETF Securities, and VanEck. And they essentially said that if you as an investor invest in our ETF and you hold it for more than 12 months, then we will pay that purchase brokerage for you on your behalf.
So you don't actually pay any brokerage on the purchase. You only pay it if you sell it within that 12 months, then you pay that brokerage. Yeah.
Exactly.
Is that the way it works? Yeah.
That's how it works.
Yeah. So what sort of time frame do you think is a good time frame for younger investors to look at?
In terms of, what do you mean, Phil, by time frame?
The best way to build long-term wealth. Like you mentioned 12 months before, but really 12 months to me is a very short window, especially if you've got years ahead of you.
I completely agree. And so most of our current investors, they're investing for 20 plus years. And they're investing for what's called financial independence right now. It's a long-term goal where people are incrementally investing over every month for 20 years. That's the beauty of these ETFs and the ongoing investment. And you kind of combine that with your super, you get to this passive income sort of level where you're actually getting thousands of dollars a month after a 10-year period of doing this that then starts compounding. And it's this beautiful flywheel of compound growth, also known as the eighth wonder of the world.
Compounding, yeah.
And so for most young people who are starting in the share market, I mean, there's two paradigms to look at this at. It's like, what's your tolerance for risk? And there are actually a few elements there, and we can dig into that if you like. But the other element is, when do you need the money? So what's your psychological tolerance for volatility? And then when do you actually need the capital? And so on the when do you need it, in an ideal world, you're actually investing for once you retire, if you're a true beginner and quite young. And so it's 20, 30, 40 years, depending on where you're at.
But if you're saving for a home loan deposit, it might be a different paradigm that you're looking at.
Yeah. And then it starts to get a bit shorter. And then it's a question of how long away is that home deposit? So in Sydney and Melbourne, the typical savings time is 9 years, in which case you're still talking about a long time horizon. It still makes sense to invest in at least a portion of equities. And you can get a blend of like equities, bonds, cash in like these diversified ETF portfolios that say BetaShares or Vanguard put out. And you could just invest, incrementally in them over a 9-year period. And currently you're getting 1% interest. Let's say that you get the market return of 4%, and who knows what will be over the next 10 years, but 4% is pretty conservative. That will get close to cutting your savings time in half. It's a huge difference that we're talking about in terms of accumulating that deposit. So again, another long-term goal it's worth doing that for. If you're just having kids now, you want to send them to a fancy private school. It's like, again, it's a big chunk of money that's going to happen in 12 years time. So again, another thing that it makes sense to invest in equities for, because if you're saving for this stuff at 1% per annum, and even at normal savings rates at 3-4%, like when the savings rates are doing that, then the market's still usually doing much better. So all of this stuff, it's like, let's start using these diversified portfolios as a tool to get to our financial outcomes sooner.
Yep. Would you recommend people putting dividend reinvestment plans in place in this kind of long-term situation?
Yeah. That's must do, Phil. So.
How do they do that? I mean, people sort of hear about dividend reinvestment plans. They don't know what's going on, and then
you're getting.
How do you do it?
You're getting pretty close to one of my biggest bugbears of the whole industry right now. Apart from the Robin Hoods, which are one thing. The second thing is that the reporting side of and the admin side of share investing is still far too archaic for what it needs to be. And so you need to log into a share registry. So you actually need to figure out, so just to take a step back, the share registry is the company that does all of the admin for the stock, for the company that you're investing in.
Yeah, and that's where you get those letters that start arriving once you've made your purchase. You suddenly get all this paperwork and you go, what do I do with all this paperwork?
Yeah, that beautiful paper trail. Exactly. So that's them. You need to go to their website, but the painful thing is that they're different ones depending on which company you invest in. And then you need to see if your company or ETF offers it. All broad-based ETFs I know of offer dividend reinvestment plans. And then you just tick the dividend reinvestment offer, and away you go. And
you also tick the email option so you don't get all that paperwork on.
Yeah, exactly.
That's just such a pain. But you have to do that every time you purchase. I know this is one of the things that people aren't warned about, that they're going to get all this paper, but there is the option to make it all email, all electronic. And what is a dividend reinvestment plan?
So dividend reinvestment plan says every time the company pays me dividends or trust or whatever it may be, pays me dividends, I'm going to reinvest those. And so you can do that for companies, you can do that for ETFs.
So you get shares in the investment rather than getting the cash.
Exactly. And so, a lot of people will invest their dividends anyway, but every time you invest your dividends, there's two things that happen. First of all, you've got some time that money isn't being invested, that it's just sitting in an account. If you're a true believer in compound interest, then you want to maximize the amount of money and the amount of time that it spends in those investments. And the second thing is that the dividend reinvestment plan skips any brokerage costs. It just goes directly in via the registry.
And sometimes there's a bit of a discount as well, isn't there?
Can be.
That's more with companies than ETFs, though, isn't it?
Yeah, typically. Yeah, exactly. Again, another good reason to sign up for this if that's what you're doing.
So, were we talking about a special promo or anything we were going to talk about today?
We do have a special deal, Phil, for the listeners.
Oh, let's talk about the special deal then.
All right then. Well, right now we're in beta, but because of Shares for Beginners support, we're extending the ability to skip our waitlist completely and just jump straight on in if you come in through your link. So if you go Pearler.com and then request access, then there's an invite code. So Shares for Beginners Beta is what the invite code is. So all one word, lowercase.
Yeah.
And you'll be through. You skip straight through. There's a little form there that makes sure that you're a long-term investor. Because we really do take it
that's right.
seriously.
There's the questionnaire, isn't it, that takes you through exactly the kind of, you want to filter out the Robin Hood types.
Exactly. Go somewhere else. And then, away we go. And so as far as the platform goes, we're getting towards the end of our beta at the moment, although we are about to add in and have actually just added in US securities. We're starting to expand that to all of our existing customer base over the coming month. And then once that happens, we'll be really launching. But this is kind of getting in ahead of the curve for anyone who's interested.
Kurt, thank you very much for joining me today.
Phil, it's been a pleasure. Thank you.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money won't.
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
At Staples Business Advantage, furnishing your office is easy. And with the best warranty in the business, we're committed to you now and down the road.
Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.